Welcome to the 39.6 Facebook Live show. Today is episode number 15. We will be discussing federal progressive tax and pre-tax versus Roth 401k contributions. This is the show that teaches you how to make your money work for you so you don't have to work for your money. Take it away, Pinky.
Hey, let's get moving. Come on, it's been around the knees.
Okay, thank you, Pinky. Got a little stuck over there. Today, we are going to continue our taxes series. Today is episode number 2 of taxes. We are going to be discussing federal taxes. So yesterday, we talked about FICA tax. We discussed Social Security and Medicare. Today, we'll be discussing federal taxation and the tax brackets. Okay, there are actually 7 tax brackets. We are not going to make it that complicated. This will be a conceptual episode. And in particular, we're going to discuss this because this is actually probably the most misunderstood thing about taxes. A lot of people think their tax bracket is where they pay all of their taxes for the entire year. And that is just, it's not true. If there's any one thing that I wish people understood about taxes, it is what we will be discussing today, which is progressive tax. Okay, yesterday, and just as a refresher, we discussed Social Security and Medicare. Social Security is a flat tax of 6.2% for the employer and the employee, and that caps once the income or once the Social Security taxable income is $128,400. For any American earning money, that is basically up to $8,000 per year out of your paycheck can go to Social Security, but then no more than that. Medicare is a progressive tax. Medicare starts at 1.45% and it goes all the way until you hit an income of $200,000 if you are single or $250,000 if you are married. After that, there's extra Medicare tax of 0.9%, which goes on for every additional dollar you earn. Okay, so Medicare is actually a progressive tax. It has one tax bracket and then a second tax bracket. Okay, federal tax is much like that, but it is much more complicated because there are more brackets and also because the tax rates are much higher. All right, so before we get into that, we're going to say hi to the people here. Thanks for coming. Lynn, thank you for coming. Osmond, and thank you, Kate. Kate is working, but she made it. And Jessica, thank you very much for coming in. And we are coming again live to you from the Monterey, where we often have been. And we are going to continue now. I'm going to post here federal tax brackets. Okay. And I'm going to show that. Okay. So I have a few tax brackets here, and this is a conceptual. Okay, these are not real. Okay, but starting on one side of the screen, okay, over here, we're going to read from left to right for you. This is 0%. Okay, so a 0% tax bracket. Okay, I hope that can be seen on your end. If you can read the numbers, please give me a thumbs up because I want to make sure you guys can read this. 10%. I have a new camera here with a wider angle. It's a little sharper, but it might make things a little smaller. 25%. Okay. 25% and 50%. Okay. So we have these 5 cups and they have different percentages, except I put 25%. I put it twice because in reality, they're not all the exact same size, each bracket. Okay. So in this particular example, I'm giving you 25% in a bracket that is twice as big as any of the other brackets. Okay. Now, federal tax is a progressive tax. And what that means is that you start off with dollars paying tax at a different level than they do as you go through the year and earn more money. Okay, so I'm going to make this so that every single cup here is equal to $25,000. Okay, so let's pretend you earn $25,000. Okay, so you work 1 year, and when I was my first full-time job, that's interesting. Okay, my first full-time job, I made $16,000 for the whole year. Okay, so for example, this was my entire year salary, $16,000. That's probably even a little bit more than the proportion should be. Okay, at that time, I was single, and there were different brackets. There are different brackets for single versus married. I'm going to make this simple. Let's just assume we're married, and the first $25,000 you earn is taxed at 0%. So let's pretend I'm a teacher. I earn $16,000. My wife doesn't work, and we managed to live off of this salary. We will pay 0% tax on all of this income. Okay, so here is Uncle Sam. Okay, and I'm going to pay him at the end of the year. We have to file for our taxes in April. Now, I know that on your paycheck, they're going to take money out of your paycheck. They're going to do what's called withholding. We are going to pretend there is no withholding, okay? Because that makes it more confusing, okay? Let's pretend there is no withholding. I earned this much money the whole year, and then at the end of the year, I file my taxes. I say, I earned $16,000. I say, I'm married, so I should have $25,000 of space in my 0% bracket or my 0% bucket. So I will pay tax on this at exactly 0%. So 0% times this equals 0. So there is no tax. Wonderful. So if I only earn $16,000 in 1 year, I pay 0 taxes. Okay. Now let's pretend, okay, the next year, my second year as a high school teacher, I earned $32,000. Okay, so that means that I filled up $25,000 into the 0% bucket, but then the next bucket of $25,000, here's my remaining $7,000 of income. So my second year of teaching, I earned $32,000. Then when I go to file my taxes, I say, okay, IRS, I'm going to pay 0% on this $25,000. That is $0. Okay. Now, this $7,000 of income was in the 10% bracket. Okay. I have to pay 10% of this to the IRS. Okay. So I'm going to measure out 10% of this. Okay. Fantastic. So I paid $0 over here, and I paid 10% of this. So if you remember, there was $7,000 in here. So $7,000 times 10% was $700. So basically, I could have earned $32,000 and only paid $700 in taxes. That's a very low amount of tax given the total amount of money I earned. Okay, that's only about 2% of my income went to tax. That's pretty good. Okay, now let's pretend I'm gonna put this money back. Okay, we're gonna go to the next year. Okay, so the next year, let's pretend I'm a resident. Okay, and I make exactly $50,000 my first year. Okay, so I have $25,000 that filled up the 0% bucket, and here I have another 25% that fills up the 10% bucket. Then I go to file my taxes. I say, how much tax do I pay on this bucket? 0. And how much tax do I pay on this bucket? 10%. Okay, so I file my taxes. I have to take 10% of this off and pay 10% of this. And I made a mess, and there's 10%. Okay, so 10% of this is going to be 25,000 times 10% of, or $2,500. So a total of $2,500 of federal tax on $50,000 earned. That's a very low rate of tax is only 5% on average. Okay, so now I'm going to introduce to you two terms. We have what's called your marginal tax rate and your effective tax rate. Your marginal tax rate is the number, the percentage that is on the last bucket where the water went into. Okay, so that is the amount of tax I pay on the very last dollar of the year. Okay, so that's the 10% would be my marginal tax rate. Now my effective tax rate, I paid 10% from here and I paid 0% from here, and they were both full. So on average, it was 5% of the entire thing. Of all of my income, I paid 5% on average. 0 and 10 average to 5. Okay, so my effective tax rate with a $50,000 income was 5%, but my marginal tax rate was 10%. Okay, so now let's pretend the next year. Okay, let's see if I can do this without spilling. Okay, good. All right, so the next year, instead of earning $50,000, I am a second-year resident. And as a second-year resident, you get a raise. You get a raise of about 2%. So now I earned $51,000. So $25,000 in here, $25,000 in here, and $1,000 in here. Okay, so let's recap. The marginal tax rate is the rate of the last bucket that money went into. So that is the 25% bracket. Okay, so the marginal tax rate is the last bucket. That means the last dollar I earned is going to get taxed at 25%. Now, the effective tax rate, well, I have to pay my tax now, and then we're going to calculate that. So on the 0% bucket, we're paying 0 tax. Okay, done. On the 10% bucket, we have to pay 10% tax to Uncle Sam. There we go. But now, over here, of this $1,000, okay, I have to pay 25% tax. Okay, so how much total tax did I pay? I paid 0 tax here, okay. I paid $2,500 of tax here, okay, because that was 10% of this. And I had an extra $1,000 here, and $250 had to go to tax because that was 25% of this. Okay, so $250 from here plus $1,000 from here is $1,250 of total tax paid on an income of $51,000. Okay, so I'm not going to do the math on that. It's 2,500 plus 250. Yeah, so 2,750 over 51,000. Actually, yeah, I can do that. So that's 5.5%. Okay, so your effective tax rate is 5.5% because you're paying 5.5% of your total earnings here. Okay, so that's with an income of $51,000. Marginal tax rate 25%. Effective tax rate of 5.5%. Okay, now as you notice, now we're in these 25% brackets. We're getting taxed higher. Okay, so let's pretend you finished training and you have half of a year where you're earning $25,000. Okay, and the second half of the year you earn $50,000. Okay, and so you fill up this third glass. Okay, so you have a total income, okay, of $75,000. All right, so end of the year you do your taxes, you pay 0% on the first $25,000, you pay 10% on the next $25,000. Okay, so I'm going to pour that out over here, give it to Uncle Sam, and I always spill that one. Okay, and then I have to give 25% of this glass. Okay, 25%. So I'm going to give up this much of the glass. Okay, that's too much. Okay, that is a little more than 25% out. I'm going to add some back in. Okay, so there we go. This is what progressive taxation is. You have 0% of this taken out, you have 10% of this taken out, and you have 25% of this taken out. So if you earned $75,000 and you use these three brackets, you're paying $0 of tax here, $2,500 of tax here, and here you're paying 1/4 of this $25,000. So that is $6,250. You add that, so you have $6,250, $2,500, and 0. Okay, so once you get into this higher bracket, you're paying a much higher percentage of your money to the IRS. Excuse me. All right, so we'll take a break for a second. Say hi to people who are here. We have Bantu. Thank you for coming. Lue, thank you for coming. Appreciate you guys all being here. Okay, for the live broadcast. Awesome. So that is if you earned $75,000. Now, if you had earned $100,000 instead, you would have filled up this over here. Okay. Now, if you did that, and at the end of the year, you squared out your taxes, you pay 0%, 10%, 25%, and 25%. Okay. There you go. So, of this $25,000, you're paying 25% tax on it. So that's again $6,250. Okay. So if you notice at the beginning of the year, if you had earned a whole $100,000, the very first, if you earned $100,000 for the whole year, the first 3 months, you don't have to pay any tax at all. Okay. You're paying 0. The next 3 months, you're paying 10% tax. Okay. So you're paying $2,500 for the next 3 months of the year. Now, the last 6 months of the year, you're paying a rate of 25%. Okay, so you're paying $2,000 a month the last 6 months of the year. So you're paying 0 tax the first 3 months. Okay, you're paying $800 of tax the next 3. Then the last 6 months of the year, you're paying $2,000 a month in taxes. Okay, so you're paying more and more tax for every dollar you earn. Now, on this example, your marginal tax rate is still 25% because the last glass you're filling up is 25%. However, your effective tax rate, you have to add up all the tax you pay and divide it by all the money here. So that's 6,250 plus 6,250, so that's 12,500. And then you add 2,500, that's $15,000 of tax. So you paid a total, and you have 0 tax over here. So you have $15,000 of tax paid over the whole year of an income of $100,000. So if you have $15,000 of tax and $100,000 of income, that's a 15% effective tax rate or average tax rate. Marginal 25, effective 15. Okay, so now here is where things get really not as favorable for the earner. Okay, let's pretend you're earning more than $100,000. So now let's pretend you are earning $125,000. Okay, so that means you're earning like $10,000 a month. Now remember, these are not real tax brackets. I'm only making them up to make the math simple and to make it make sense. The real IRS brackets do not get to 50% ever. And if they did, it would be over $500,000 of income. Okay. But for the sake of understanding how taxes work, we're going to say that once you hit the $100,000 income mark, you're going to be taxed at 50%. So you're earning $10,000 a month, $10,000 a month for the first 2.5 months you're here, 2.5 months you're here, 2.5 months you're here, 2.5 months you're here. Okay. But then the last 2 months of the year, okay, now I need to fill up a glass over here because I'm out of water. Okay. All right. So this was, okay, actually, you know what? I'm going to pour this back into there so I can reload. Okay. So here was, okay. And just for the sake of being complete with one comprehensive example, okay, so you earned the full amount. Okay. All right. So you earned $125,000. You pay 0 tax on this. You're paying 10% tax over here. Okay. You're paying 25% tax. I kind of didn't have enough to fill that one up. So now let's go a little lower. Okay. There we go. 25% tax. And a little bit more just to make them the same. Okay. 25% tax. Then this guy over here, this is, okay. Here you go. Uncle Sam really likes you, okay? Because you're really helping Uncle Sam out. This last 2 months of the year, you gave up a full month of your income, okay? And you're giving that all to the rest of the country. It was very nice of you to do that. So now your marginal tax rate is 50% because you have reached the 50% bucket, okay? Now that is not ideal in the sense that you don't necessarily want to be paying taxes that high. On the other hand, you still have a lot more money than you did if you had not earned that money at all. Okay, so you still end up with $12,500 more than if you only had a $100,000 income. But you got taxed at 50%. So the benefit is more money to you, but you're giving up a lot more. Okay, so here, your effective tax rate, $0 in the 0%. You're paying $2,500 at the 10% bracket, $6,250 and $6,250 at the 25% bracket. Okay, so that's $12,500 plus this $2,500, that's $15,000, just like it was before. Okay, but then here, you're doing $12,500 or half of this money. Okay, so $12,500 plus $15,000 is $27,500. So what's happened is you've paid $27,500 in taxes and you've earned $120,000. Okay, so if I punch that into the calculator real fast and 27,500 divided by $125,000, that gives me 22%. Okay, so you can see my ring light there. I just got a new ring light, so I'm not quite as dark. All right, so 22% effective tax rate. So even though there is no 22% bracket, the average tax is 22% if you average all of these out. Another way of saying that is if I were to even these guys all out. Okay. There we go. Okay. They're almost all even. All right. Okay. So there you go. We're going to assume that these are all even Steven right across the top there. Okay. So basically, if I just averaged out the amount of income, okay, and the amount of tax in each bucket evenly, it would be 22% missing from each one. So over the course of the year, the average taxation was 22%. However, it was really 0% for the first 2.5 months. Then it was 10% for 2.5 months, 25% for 2.5 months, 25% for 2.5 months, and then 50% for the end of the year. Okay, so this is how you would calculate your effective tax rate, but in reality, you're paying it down in a progressive fashion. Okay, so I'm gonna go back and put it the way it was. I have to fill up this guy. That's what has to get filled up. Okay, so that guy's filled up. This one is 10%. These two are 25. Okay, I need to put a little bit back into there and a little bit more into here. Okay, so there we go. We are at 0, 10, 25, 25, 50. Okay, so now this is where a lot of people get very confused. I see this question all the time, and it's the Roth versus pre-tax question. Okay, so the person says, I have to make a choice. Should I put money into my 401k as pre-tax contributions, or should I put it in as Roth contributions? Okay, Roth contributions, they will go in. You will not take any tax deduction. The amount of tax you pay for the year is exactly the same. Okay, so there's no tax deduction at all. So in this example, I've already paid the tax. Okay, so I'm going to do a Roth 401k contribution. Okay, and what I'm going to do, okay, here's my 401k bucket. Okay, if I want to put money into my 401k, I've already paid the tax. The tax there's no change in the amount of tax. Okay, so it doesn't really matter to me what bucket I take it from because the tax is paid. Okay, so what really happens is, watch this. There is 12,500 in there, right? And over here, there was 25,000 minus 25% of that, which was 6,250. So 25,000 minus 6,250, that's right around 18,500, which is the amount of money that can go into a 401k. So I'm just going to swap it out. Okay. So basically, now I have Roth 401k. This money is inside my Roth 401k, and it's going to grow without having to pay any tax to the tax man. Okay. All of the interest that any bonds in here earn, and any dividends that the stocks earn, and any capital gains that I have to pay taxes on if I sell anything inside it, all of those taxable events will be sheltered from tax. There will be no money leaving here to go into the tax bucket while it is inside. Okay. And in fact, because it is Roth, even when you are retired and you pull it out, you will not pay taxes when you withdraw any of the money in it, whether it's the original money, which you see here, or the earnings that it will grow. Okay, so that will be tax-free forever. So a Roth 401k contribution does not affect your tax at all. Okay, you will pay the exact same amount of tax as if you had not put the money in there. Okay, that is simple. Okay. We are going to go back to, you have not made your contribution yet. Okay. So now, if you choose to do a pre-tax 401k, okay, so your pre-tax 401k is going to be different. Now, money that goes into a pre-tax 401k, I'm going to take it off of the pink here, okay? And I'm going to put it here next to the 0 because it is also 0% tax, but this pink is your tax brackets. So this basically means that this money has been touched by Uncle Sam. Over here, it has not yet gotten to Uncle Sam. Okay, so pre-tax 401k money. So I have to fill this up with $18,500. The question is, which bucket will it have come from? The answer is it comes from the last bucket. Okay, so we are going to start over. Okay, and I am going to fill these guys back up to show you what it will actually look like. Okay, so when you earn the money, okay, the money is we're gonna fill it up, and we're gonna do it in the order that it would have happened. Okay, so all right, here is, okay, here's your income over here. The first $25,000 went into here at 0%. Okay, the next $25,000 went into here at the 10% bracket. We're going to pay all the tax at the end. Here, another $25,000, so we're up to $75,000. Okay, here we're up to $100,000. Okay, then last, if you decide to put money into your 401k, okay, we're going to put the $18,500. You can actually, I could have put it at the very beginning of the year or the very end of the year. It didn't really matter. Okay, so there's $18,500. Okay, and that means I still have $6,000 left. Okay, that $6,000 left, I've filled up $18,500. You can only put $18,500 into the 401k. So the last $6,000, okay, the last $6,000 goes over here. Okay, so what happens is the amount of money that went into the 50% bracket is a lot lower than it was before, because instead of filling up the 50% bucket, we diverted a portion of it into the pre-tax 401k. So we decreased the amount of money that is subject to the pink box, subject to taxation. Okay, so now when I go pay Uncle Sam says, okay, we're going to take 0% out of here. We're going to take 10% out of here. Okay, there's 10%. We're going to take 25% out of here. Okay, that's 25%. Okay, and then we take 50% of just the amount that's in here. Okay, so remember, when this was full, we paid 50% tax of the whole thing. But since this is much smaller, you're only paying 50% tax of this. Okay, and so this one only had 25,000 minus 18,500. So this only had $6,500 in it, and 50% tax, I'm only paying $3,250. Okay, so what has happened is, now look at how much money I have. I have a lot more money than I did if I had put it in here. Because if I had put it in here, I would have had to give up half of this money to tax. But because I never put it into this last jar and I put it in here, I have this whole extra glass with a lot more in it. If I were to put this back into here, you would see that we're more than halfway full. Okay, actually, it would basically fill it up. So by moving money into a pre-tax bucket, I avoided paying taxes on it this year at the 50% level. Okay, if I had done a Roth contribution, I would be paying a lot more money in tax. Okay, I would have had to basically, this glass, remember, substituted from here, and you ended up having one less glass. It was a lot less money, okay? Because we were taking out 50% from here. But because we don't have to take 50% from here and only taking 50% from a very small portion that was left, we are basically keeping money out of the 50% bracket where the IRS takes most of our share. So if you are in a high bracket, okay, it makes a lot of sense to try to defer that money into your 401k, okay? And when I say in a high bracket, I mean your marginal tax rate is very high, okay? Because that money will be sitting here in a 401k and it has not been taxed yet, okay? But this is what happens when you retire. When you retire, this 401k bucket is going to be very big because you're filling this one glass up every year for, let's say you do this for 30 years, but you also have all the growth, okay? So if you had put 18,500 in here in 1 year and you do this for 30 years and it gets, let's say 6%, you're gonna have, I don't know, around, let's say 3 million or so. Okay, so then you have $3 million in this 401k. Okay, then when you are retired, let's pretend you only need $50,000 per year in retirement. Let's just say. Okay, well, I'm going to pour these guys away. Okay, and we're going to pretend we are retired. Okay, and so we have to have our buckets empty again because now is a new year and we're going to pay ourselves. But instead of paying us income from our job because we're no longer working, we're going to pay our taxable income, which is really just our 401k withdrawals. We're going to pay that from our big 401k glass. Okay, now this glass right here is too small. Okay, so what I'm going to do now is I'm going to cheat and I'm going to say, well, here is now your 401k. Okay, so there, this is your big 401k bucket. Your 401k, if you are retired and you are living off of $50,000 a year, well, remember, the first $25,000 is going to go to you all in the 0% bracket, okay? So this money would have been taxed at 50% when you were working, okay? But now, because you put it pre-tax, this portion is getting taxed at 0%. You always want to fill up every 0% bucket you have access to, okay? Then the next $25,000 you pull out will be taxed at 10%. Okay, so now at the end of this year, Uncle Sam says, I need my share. Uncle Sam takes 0% of this, and then Uncle Sam takes 10% of this. Okay, so back to that, only 10% out of this bucket, that is $2,500. Okay, so you're only paying $2,500 in tax this year. Okay, whereas if you had paid 50% of this back years ago, that would have been $12,500. Okay, and this over the course of 30 years would actually be 8 glasses worth. Okay, on average stock market returns. Okay, so you are taking it out and you're paying a 5% average tax rate. But let's pretend this $25,000, it really ends up being worth $200,000 when you're 30 years from now. So you say, let's just take out $100,000 a year in retirement so you have the same lifestyle you had while you were working approximately, or 80% of the same income, which is very reasonable. So instead of having $50,000, I'm going to give you back to the $100,000. Okay, $100,000 of income. Okay, and this is all coming out of my 401k. Okay, so now you have to pay the tax man. So you're paying the tax man 0% here, 10% over here. Okay, then you want to pay 25% from these last two. This is just like we did before when we were increasing our income. Okay, so 25% over there. And so what's happened is you would pay $2,500 over here, and then $6,000 and $6,000 over here. So this is $12,500 plus this is $15,000. Okay, so out of your $1,000 that you $100,000 you put in here, you paid $15,000 of tax. Okay, whereas beforehand, you would have paid $12,500 in tax just from this bucket alone, okay? But this ended up being actually $200,000 when you're retired. So you're only paying $15,000 in tax, but you still have another $100,000 sitting around that's still invested in growing and making money. So you end up pulling the money out all at 0, 10, and 25%. You are not pulling out a single penny at the 50% bracket. Okay, so when you are a high earner and you are up in a high bracket, especially if you're over 30%, okay, in general, it makes sense to do pre-tax, because when you're retired, you'll be taking money out at the zero again. You're always going to have a 0% bracket that you can fill up. If you had all your money in Roth, you would take out your money, there would be no taxation. But this 0% bucket, you're not even using it. That's a waste. You want to use your 0% bracket every single year of your life. That is tax-free money. Okay, if you don't use that, you prepaid at a higher bracket, so that you're paying basically more for something early as opposed to less later. That's the worst of both worlds. It's one thing to pay more for something later in life because you waited, but it's worse to pay more now than it would have been later. That's just the worst. Okay, so that is the difference between pre-tax and Roth. Roth will not save you any money today, but pre-tax will. The reason why people like to do pre-tax is because in retirement, you are much likely to have lower taxable income than when you are working at your peak income. Now, let's pretend you're just a resident and you're earning $50,000 a year and you're only here in the 10% bracket. Well, by all means, go ahead and do Roth if you're planning to get up to the 25 and 50% brackets later in life. Because if you can prepay at 10% and never pay tax on it again, that's fantastic. Okay, but if you're already here, there's no reason to pay tax on this now if you can save it later and try to get it out anywhere lower than this 50%, 0, 10, or 25, okay? Now, people will say, well, my income is gonna be high when I'm retired. It may be, okay? But remember, when you're putting it in, it's coming out at the very last bucket. You still have to fill up all of those lower buckets before you even get there. So when you're retired, if you're not working, you still have to fill that up before you get to the top one, okay? The last thing I'll mention is that there's something people say called required minimum distributions. Your 401k is going to get very big, and when you're age 70 and a half, the IRS starts making you take money out of there, okay? Well, that amount of money could be very big, and it could potentially put you back up to a top tax bracket. It is certainly possible, okay? But you would still have to go through all the lower brackets first, okay? So don't worry about required minimum distributions. Even if you're at a very, very high income right now and you think you're going to have a very high income later, there are many things between now and later that can get in the way of that happening, okay? If you have a net worth of like $5 million or more in pre-tax money, or that you're already on the way to get to $5 million pre-tax, then I would start considering prepaying even at a higher bracket. But really, I would advise having 10 million or more, in my opinion, based on the way the math works. Because required minimum distributions is only about 4% when you're age 70 that has to come out. So if you had $10 million of pre-tax money, 4% of that's only $400,000. And in fact, with the current brackets, $400,000 does not even get you to the top bracket. So you would have filled up every single lower level up to where the 400 comes in, which is at currently 35%. Okay, and that's for another discussion. But the point is, if you're at your peak earnings and you're at a high bracket, there is no reason not to do pre-tax unless you already have a very big pre-tax nest egg. If you are at a low bracket and you expect your income to be high the rest of your life, if you're very low, like in the 10% range, it makes sense to go ahead and do Roth, okay? But if you are at a low bracket, but you never plan to go higher, okay, if you are at the 10% bracket and you don't think you're ever going to get out of that, it still makes sense to do pre-tax because you want to have pre-tax money so that when you're retired, you can fill up the 0% bracket. Now, if you are at the 0% bracket and if in 2018 you're only earning is $24,000 or less of earned income and you have no other income, there's no reason not to do Roth because remember, Roth does not change the amount of tax you pay, but you're already paying zero tax. So by all means, put it Roth and never pay tax on it again. But if you're any bracket higher than that, it can make sense to do pre-tax. Okay, so there you have it. We have federal progressive tax rates. We discussed marginal tax rate is the last bucket you put into. Pre-tax is effective tax rate is the average. And the very last thing I'm going to discuss is doing both a pre-tax and a Roth 401k. Okay, so let us pretend you are at this very last bracket, okay? And let's pretend you earn, in this example, $110,000. If you earned $110,000, we filled up the 4 at $25,000, okay? And we have $10,000 here, okay? I'll make a little more than that to get to 10,000. Okay, so here is $110,000. You only have $10,000 at the 50% bracket. You may choose to do this. You might not want to have all of your money go pre-tax. You may only want the portion at the 50% bracket to go pre-tax. So you take $10,000 out of the last bucket and you put that into your, here's your 401k, okay? Then $8,000 of this, so that's your pre-tax, and then $8,000 of this, we're gonna put that into a Roth 401k, and that will still be here in the tax bucket, but now it's over here, okay? So now you have a Roth 401k, which is not labeled, okay? And this is over here with your 25% bracket. So what's happened is you haven't decreased your amount of money you're paying in taxes based on that because you did not want to take a deduction at the 25% level, okay? You only wanted the deduction at the 50% level and you wanted to pay the tax at 25% because you think when you're retired, you're going to be at the 25% level or higher, okay? And the very last thing is if you are considering doing what's called a Roth conversion of pre-tax money, that is a taxable event. So if you have, let's say 401k money that's pre-tax and you have to decide if you want to pay taxes on it, if you want to convert it or not, you will have to pay taxes based on what buckets it goes into. So I saw a question today and the person did not know what rate it would be taxed at. Well, if you have, let's pretend this is what your buckets look like. If you want to do a Roth conversion of all of this, the first portion will get taxed at 25%, and then the rest of it will get taxed at 50%. Okay, so you might not want to do a Roth conversion of all of the money. You might just want to do a Roth conversion of the portion at the 25% bracket, not the whole thing. Okay, so that's why it's very important to know where your income is in the year so that, for example, in December, if you want to do a Roth conversion, you know what is the last bucket you have to fill up and you know how much room you have left in it. Okay, that is Penelope, who's very excited right now because I'm talking about Roth conversions. All right, that is it. That was a long episode. Federal taxation, tax brackets, effective tax rates, marginal tax rates, Roth conversions, pre-tax versus post-tax. We covered it all. Thank you very much for those who've stuck around. And please share this with your friends. Remember to go to my webpage, 39.6.com. If you go to the webpage and you subscribe, you will get our emails when we send them out. You'll get notified when we have a new post on the blog. And if there are any questions you want me to address in future episodes, please let me know and I will try to cover it. So until then, take it away, Pinky.
Hey, let's get moving.